So welcome back to another video. So in today's video, it's a revision series that I have decided to do for you guys. So we're still focusing on paper 1 this week. Make sure you checked my 3 previous videos where I did the accounting equation and the fixed asset note. I also did income statement, and I did the balance sheet video. So it's just separate videos. So in this one, we are doing ratio analysis. So without wasting any more of your time, let's get right into it. So guys, this is from the Eastern Cape Provincial Department. Please subscribe, please share with your friends at school if you find this information quite valuable. Okay, so what you have to know, guys, with regards to ratios is that financial statements, which in grade 11 you only do business income statement and balance sheet, they need an in-depth analysis. Okay, so we need to analyze them. So that's why we have interpretations of financial statements in the form of ratios. So they tell us exactly how the business is performing. So we're not just going to look at the net profit or look at assets and owners' equities and liabilities are balancing. That's not all. We have to know if sales have increased, what is the percentage of increase in sales, our gross profit, our net profit, if our expenses are going up or going high. So ratios help us to know everything detail by detail. Now let's look at what different ratios represent. So here we have category. This is profitability and operating efficiency. So when they say comment on the profitability of the business, you look at gross profit on sales, financial indicator, gross profit on cost of sales, operating expense on sales, operating profit on sales, and net profit on sales. So this is when you ask, okay, the owner of this business is asking themselves if they are handling money in a right way or whatever. And then the question, and then the instruction will say quote profitability ratios, right? So these are the ratios you have to be quoting when we're talking about profitability, because a profitability analysis involves calculating profitability by using line items. Line items, material. Remember about materiality from the statement of comprehensive income, but it also includes analysis and profitability in relations to items in the statement of financial position. So that will be things like capital invested in assets and in relation to other source of capital. So and the analysis of the profitability in relations to the capital invested in assets gives an indication of management's effectiveness in the utilization of funds available to the business. So we have to know how the management effectively uses funds available to the business. So we quote this ratios. This is for profitability. And then we go to solvency. When we say quote ratios with regards to solvency, that relates to solvency. That is net assets, and that is the solvency ratio. Okay, so you quote the solvency ratio. What is solvency, guys? Solvency is the ability of the company to repay its debts in the long term. So that's where you will take total assets to total liabilities. Your total asset should be more than your total liabilities, so that you can be able to pay your liabilities if the business was to be closed down. So that is solvency. Okay, just know that. So not total liability, the ratio is not only limited to current. I wanted to say it's not only limited to current liabilities and current liabilities. So we look at the total assets and the total liability, right? This ratio is total asset is total liability. So will the business be able to pay off all its debts if the business was to close up? So we look at the asset, the number of the ratio of assets to liabilities. So you need to have more liabilities than you have to have more assets than liabilities. Now let's look at liquidation ratio. So this liquidation ratio is the ability of the company or a business or a partnership, in grade 11 you're doing with partnership, to repay its debts in the short term. So will the business be able to pay its debts in 12 months? So that is short term. That's when we look at the liquidity ratio. That's what they're talking, if they want you to quote. So this is how you comment. The business will be able to pay back its debts in the short term. So current assets is to current liabilities, right? So your current asset must be more than current liabilities for the business to be able to pay its debts in the short term. So liquidation, you look at the current ratio, the acid test, stock turnover rate, stock holding period, debtors collection period. So those are the ratios you look at, and the net current asset or net working capital. So with liquidation, you look at this. So liquidation is short term, solvency is long term. Will it be able to pay its debts in the long term? That is solvency. In the short term, it's liquidity ratio. So the main liquidity ratio, the main one, is the current ratio, is the acid test ratio, and the working capital ratio. Those are the main one. And then we can talk about the risk gearing ratio. Whether the business is able to get into a debt. So that's what we will use them. Risk ratio. If the business want to take a loan, let's say for instance. Now return is return on investment. The owners have taken out their money to invest in this business. So we look at the return on average owner's equity. Sorry, are they getting enough from the money that they have invested? That is the return. So we look at the return ratio when we analyze whether it was a good investment for the owners to start this business. Let's look at the formula that you are given from school. So this is the formula sheet that you are given at school. So they give you this formula sheet, and it's very important to know what formula is used for what. Very important. So let's look at the question, where this question paper was downloaded from the Stanmore website. So this is question 4, financial indicators and interpretation of financial statements. And then you are provided with the information of your partners for the financial year ended 28 February 2023. Calculate the following financial indicators on the 28th of February 2023. So we are asked to calculate the operating expenses on sale, the acid test ratio, the debt equity ratio, and the percentage of return on average partners owners equity. Provide figures, trends. So this is for partnerships, grade 11. Provide figures, trends, financial indicators or calculations in each case to support your comment and explanation. So here is, you have to comment here. That is where you have to comment. Guys, this thing is free marks, free marks. Explain whether the business is managing its expenses efficiently. Remember, we have operating profitability ratios. You would know there. That is what you will use. Identify 2 financial indicators with figures to support your explanation. And then partner also is concerned about the liquidity position. Explain whether he is justified or not. You quote liquidity ratios. I have just shown you. The partners have increased the monthly installment on the loan. Explain the effect of this on the financial risk of the business. Quote 1 financial indicator with figures to explain to support your explanation. Explain whether the partner should be happy with the percent of return and by their investment in this partnership. Quote one financial indicator with figures. And then here we have supporting information. All right, now let's start to write all the formula on question 4. And then we'll have the first one that we've got is percentage operating expense on sale. So that's the first thing that we have to calculate. So to calculate this, we will have operating expenses. We'll have operating expenses divided by sales amount. So I will show you where we got the amount. The sales amount is 845,100, and that will be divided by 3 million. Sales was 3,380,400, and then all of this will be multiplied by 100 divided by 1, and that will give us an answer of 25%. So 25% will be the answer for 4.1. We are asked to calculate the percentage of operating expenses on sales. So this ratio written operating expenses on sales is the one that we are going to use. So it's calculate operating expenses on sales. So use the first one, the operating expenses on sale times 100/1. And then let's look at the income statement here. It's a bit blurry, we'll get better. So I took the amount of operating expenses, with this 845,100, and divided by the amount of sales on the 2023 block for 3,380,400 rand. So those are the ones that I took. And then now we are going to have to calculate on the next one, acid test ratio. So the acid test ratio, the acid test ratio, we're going to use this ratio at the bottom, where it's current assets minus inventory is to current liabilities. So that's what we'll use for the acid test. So there is current assets on the top there for 2023 block is 557,800. We will take that and minus inventory, which is 231,800 rand. And then we have current liabilities at the bottom there, which is 287,900. So remember, we are looking at, when with acid test, you look at things from the statement of financial position. All right, so we are doing the acid. Let's change the color. Acid test ratio. And that is calculated by saying current assets subtract inventories or stock is to current liabilities. So that is how you calculate that, and then you're going to take your 557,800, and then subtract 231,000 rand. So put that inside your brackets and say this is to current liabilities, which is 278,900 rand. And then on the next step, you're going to minus the 231 from the 557. That will give us 326,000. And then we will do let's say first it's 278,900 rand. So after doing this step, you say 326, this is how you do it, divided by 278,900, and then you will get 1.2. So how you write the answer, you will say 1.2 is to 1. So this is how you will write that. So 1.2 is to 1. It means your current asset minus inventories are 1.2 more than your current liabilities. So this is how you calculate the ratio parts, but the ones that wants percentage, you just do them this way. I hope that helped you guys a lot. And then the next one we're going to do is debt equity ratio. Yeah, so this is the second one. Let me just change the color to black. We only write final answers in that color. So that how to calculate it is non-current liabilities is to owner's equity. So this is how you calculate the debt equity ratio. So in the balance sheet, extract from the balance sheet, you are going to take partners equity, which is 2,176,210, and that will be your owner's equity. And then take loan from Komani Bank, that's 1,300,200. Is it like that? Correct me, guys. Yes, that is the amount that you're going to take. Okay, non-current liabilities to owner's equity. Down at the bottom there, the bottom of the formula sheet, that's where we found this ratio. So we will calculate this. So we have 1 million. Or is it 1,300,200? I think so. It's to 2,176,210. Yes, like this. And then you will take the 1.3 and then you divide it, the non-current liabilities, divide them by owner's equity, and then that is going to give you 0.6. Then remember it's a ratio, so we write it like this: 0.6 is to 1. But as you can see there, let's highlight this first. As you can see that owner's equity is more than debts. You see, so your debts, you're trying to check that how much debt does the business have. So it has little debt as compared to owner's equity. It's at 0.6%. Yeah, that is very low. It's not a percentage, it just says 0.6 is to 1. So there's still 40 for so owner's equity is 4 times more. It still has 4 before it gets to 10. You see there's still a gap between 6 and 10, like there's like 4. So we have little debts. Yeah, so it's not really bad. So let's for number 5 we are going to calculate return on average partners equity. Then we calculate that by saying total earnings by partners divided by partners average equity, and then multiply by 100, multiply by 100 divided by 1. So let's put that like that. Yeah, this is there, but you write the way it was written on the formula sheet. Here I can't write that division line. So average partners average equity, you take equity for last year plus equity for this year and divide it by 2. So that is how you get average equity. So here is the total earnings by partner, and then over partners average equity times 100 over 1. So this is one, you're going to write it like this, not the way I have written it. So earnings by partners is the net profit for the year. So we're going to take 591,570 from the statement of comprehensive income, and then on the bottom we are going to look at the equity, partners equity, 2,176,210 plus 1,945,920. That is partners equity. You're going to add them and divide them by 2, and we'll have the bottom part. So that's 591,570 divided by 2,176,210 plus 1,945,920, and then you're just going to do them. Yeah, after doing this, you will just say 591,570 divided by let's say 206. Oh, like this. So this part, we will add them together and then multiply them by like this, 1/2 of this. This is the final one. And then we will times this by 100, divide by 1. That is where we will get 27.7%. So this is the final answer. This is the final answer for return on average partners equity. So for the next part of the question, we are going to look at this ratio, this table here. So you can write it down somewhere, but this is the table we are going to look at, and then just divide them: profit ratio, equity, solvency, and all that, and then we can answer the questions that follows. So guys, this is the memo, complete memo that we just did for the questions that we just did. 4.1, there is the workings on operating expense on sales, the asset test, the debt equity ratio, and the return on owner's equity. So this is how you do them. Now let's get into this part. So the highlighted part is the question. So I'm just going to do it with the memo so that the video is not too long. Explain whether the business is managing its expenses effectively. Identify 2 financial indicators with figures to support your explanation. So you have to explain whether the business is managing its expenses effectively. So you're going to be given 2 marks for any 2 financial indicators. So we have operating expense on sales, decrease, improved from 20. So expenses decreased from last year from 29%. When we check the table that I asked you to look at, the expenses went down from 29% to 25%. So the business is managing its expenses effectively with that regards. And net profit on sales improved from 13% to 71.5%. So you see, the business is managing expenses well. A decrease in operating expense and an improvement on sales contribute to a significant increase in the net profit. So for 4.2, I hope you understand that one, guys, as well. Partners Yozo is concerned about the liquidity position. Explain whether he is justified or not. So I'm showing you how to answer these questions. Quote 2 financial indicators with figures. So liquidity is current ratio, asset test, debtors collection period. So any 2 financial indicators between the 3, you get 2 marks. And then figures meaning an increase. So current ratio increase from 1.6 to 2:1. And then asset test increased or improved from 0.7 to 2.1:1. And then yes, data collection improved. So the amount of days, how long it takes for debtors to pay or to collect, from 36 days now to 29 days. You should not be concerned about the business has enough current or liquid asset to meet short-term debts. Yes. And then 4.4 says the partners have increased the monthly installment on the loan. Explain the effects of this on the financial risks of the business. The partner have increased the monthly installment on the loan. Explain the effects of this. So it's 4 marks. You're going to get 1 for financial indicator, for figures of trends, an increase from what to what is a mark, and then 2 marks for explanation. Debt equity ratio decreased or improved. So the debt equity ratio was 0.7:1 and now is 0.6:1. So yeah, that did not affect them in any way. Although the debt equity ratio improved, the company is still high risk, rely too much on borrowed capital, so it has to go down. Explain whether the partners should be happy with the % return earned by their investment in this partnership. Code 1 financial indicator with figures. The financial indicator get 1 mark, the figure with trends get 1 mark, and explanation get 2. So return on average partners or owners equity improved from 17.8% to 28.7%. Comparison with interest on fixed deposit, the return is higher than alternate investment. So you see, it's not actually good to have debts anyway, so business should limit their debts as much as they can. So that was the end of this 30 marks. I hope you enjoyed the video. Please don't forget to like, comment, and subscribe to the channel. Until the next one, bye.